This is a special edition of the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Dianne Crocker. This week, our regularly scheduled programming included an interview with Mike Flood, who's the Senior Vice President of Commercial Multifamily Policy and Member Engagement at the Mortgage Bankers Association, and we will release that recording early next week. But given the Fed's rate cut announcement on Wednesday, we didn't want the week to go by without giving our hot take on what the surprise 50 basis point cut means for the CRE market and broader U.S. markets. Certainly, the markets reacted quite positively, with stock prices soaring on Thursday. Manus, let me get your initial reaction.
Well, the most obvious thing for our listeners, for people that follow the CRE markets, is that this is an unmitigated piece of wonderful news for the CRE market. As we all know, it's been a very challenging market. High rates have pushed up distress levels. They've made it hard for borrowers to refinance. They've squeezed out profits for operators of multifamily properties that use floating rate debt to purchase their assets. So on all accounts, this is terrific news for the CRE market. When you widen the lens a little bit further, when you look at the broader markets, analysts, investors, market watchers were really cheering the news today. On Thursday, the day after the Fed announcement, stock prices shot up. The NASDAQ was up about 2.5%. So people have certainly looked at this as a risk-on moment. We were taken by surprise. For those that listened to our podcast last week, we were pretty unanimous in calling for 25 basis points to be the number yesterday. As it turned out, it was 50. So we were all a little bit surprised by this. We'll peel back that onion a little bit more in the next few minutes. But great news for CRE. The markets are exuberant today about this. It does bring up some questions, and we'll dive into the impact on several different parts of the industry as we spend the next 20 minutes on the topic.
Up until like July, maybe mid-August, the conventional thinking was, everybody was expecting a 25 basis point cut, and 50 wasn't even really on the table until all of these mixed signals started coming in about retail sales and the cooling labor market, which we've talked about on the past in recent weeks. And then the chatter about 50 basis points started getting louder, and here we are, and it's officially on the books. So to your point, Manus, Wall Street's very happy. They had a very favorable reaction, not surprisingly. And the Fed wants to stimulate economic activity, which, comes with some dangers, which I think we're about to talk about.
When you walk down the street and you see a loose $20 bill, you bend down and you pick it up, and you don't ask where it came from, and you don't ask who lost it. You just stick it in your pocket and you walk away smiling. As far as the 50 basis point rate cut goes, it was kind of like finding a $20 bill on the sidewalk for CRE investors, brokers, property owners, et cetera. But if you look at the other side of the coin and you think, where did this $20 bill come from? It raises a lot more questions. I keep coming back to the word paradoxical when I talk about the Fed's decision to go 50 basis points. And I'll mention that on three different levels. Never before has the Fed cut 50 basis points other than in periods of great turmoil, like after the dot-com bust or during the great financial crisis. It is happening when stocks are at an all-time high or close to it, where PE multiples are well above historical norms, and also when housing prices are already very, very hot. It's very, very hard to find housing. So it is kind of paradoxical that they would see enough weakness in the economy to push through a 50 basis point cut in the face of what looks like a very, very solid U.S. economy. Adding to the paradox is the fact that Powell came out after the announcement and did underscore that the U.S. economy is strong. So again, for the CRE market, I am thrilled to pick up that $20 bill. I am thrilled to see refinancings pick up, distress level off, banks see better valuations on their loans that they're holding, borrowers getting to refinance and see some recovery in property values. But it is a little bit of a head scratcher.
So my question is, do you think the market believes what he said yesterday?
I think some do. I think the inclination is the market wants to believe that the economy is strong, wants to Manus, your point, wants to move capital back into play. There's a psychological boost to this, right? We can't discount that. We all knew for some time that rates would come down eventually. A lot of people thought it would happen in May and June. It didn't. And now they officially are. And it's meaningful. It's not abstract now, it's concrete. And it was higher than most people thought. Our industry runs on positive juju. And, this $20 bill is positive juju. So I think there's going to be more optimism. We're going to see this sense of momentum that we've already been seeing in the Lightbox activity index for the past few months. But I don't think it's all blue skies and rainbows. We need to curb our enthusiasm a little bit. I think the market's facing some pretty significant risks over the near term, to say the least, and it's pretty fragile and subject to some wild fluctuations, which we saw in early September.
I think my two biggest concerns are, number one, we've seen a couple of dips in the stock market. There has been some breaks in confidence over the last 6 weeks. If we go into an extended period of risk on, where the markets get exuberant, we see a 6,000 S&P 500. It just means that the next downturn is going to be that much more painful for investors. So that is a concern of mine, that people plow into this market at exactly the wrong time to be plowing in, the individual investor. But the other side of it is, and this is the most concerning for me, is housing makes up a big part of CPI. Housing has been very expensive for a long time. There's two parts of it, of course. Single family housing has been through the roof. If this turns out to make it such that we go back to a period where every house has 12 bidders, every bid is $50,000 above asking, every house for sale goes through a bidding war, that will be reflected in CPI eventually. People will be priced out of houses. People will have to stay in multifamily. Prices will go up. Certainly, there's not enough supply in either segment at this point. And that's my biggest concern, that by opening the spigots this way, it will introduce problems that we just don't want to face next year. That being said, in those two areas, we're taking what were very good markets and making them great. In CRE, we were taking what was a very dented market and hopefully making it more stable. And that is the real silver lining for our listeners.
So if the economy is strong, as Powell suggested in his presser after the decision, why the need for 50 basis points?
And certainly, there's no unanimity in that point. Yesterday on CNBC, for a long stretch of the afternoon, Jeff Gundlach was on economy. He's a major bond fixed income investor, runs a huge fund out of Los Angeles, deep into everything fixed income, including CMBS, big holdings there. And he was saying, we are already in a recession. There are people out there that are saying that, forget what you're seeing out there, we are in a recession already. We saw the retailers 6 weeks ago, kind of one after another, say that the US consumer is tapped out. So perhaps Powell and rest of the Fed members are seeing something that we're not seeing. But from where I sit, this feels nothing like the dot-com bust, nothing like the great financial crisis. This feels like very much a garden variety, middle of the road US economy, not too hot, not too cold. And it does beg the question, why the 50? What do they see that we don't?
It's a good question, and what you just said reminded me of like economics 101. It takes a while for the data to kind of paint that picture, and maybe we are, maybe we're not. I think the next couple months are going to be very telling in terms of what the data shows. I think the November decision about interest rate cuts, if it goes down to 25, will be very telling. And obviously we have the election standing between now and that next meeting.
Certainly, there are people out there that think that this was political. People may be listening thinking, of course, this was political. Maybe this was political, whatever. The reason we're not weighing in on that, honestly, is we'll never know. You're never in that room. All you could look at is the data, the unemployment, the CPI numbers, the PPI numbers. And there's almost no point in speculating whether it was or wasn't. People will have their opinions about whether that was an influencing factor. What can you say? We'll never know whether this was at all a factor. All you could do is look at the data.
And clearly, this marked a shift in policy. One of the things that came out as well after the meeting was the dot plot. And for those of you who don't pay attention to that, it is essentially the forecasting based on the voting of the FOMC on where they see rate cuts going in the next 2 years, essentially. So the central bank's committee voted on a number of cuts that take us about another 50 basis points lower by the end of 2024 and another full percentage point in cuts at the end of 25 and a half point in 2026. So by the end of 26, we're looking at obviously a very different market than we have currently.
Time will tell over that for sure. I'm not a fan of that kind of heightened cutting unless we really hit the rocks, unless we are in a recession. And perhaps that's what's coming. We've seen unemployment tick up. We certainly don't want to see unemployment touch 5%. We want to see the job market remain strong, and maybe that will be necessary. If this is just what goes up must come down, that we went up to 5 and then we have to bring it back down to 2, I wouldn't be a fan. I think that this market remains, other than the CRE space, highly valued, highly speculative. And I'd be very cautious if I were the Fed that triggering another run up could be what lower rates begets.
If November and December each brought another 50 basis points cut, that's a lot in a very short window. And it doesn't give the market enough time to really respond to it, and then for the Fed to respond in turn. So I'm hearing new phrases, Manus. We talked about it used to be like more in 24 and then survive till 25. And at a conference I was at last week, they're saying take your licks till 26 and won't be heaven till 27.
Survive until 25 means we only have another 3 months before we start getting back to those 2021 numbers, or at least closer to them than we've been for the last 2.5 years.
So let's get a little bit further into the weeds. Let's look at impact segment by segment, and we're going to start with banks.
So the banks cheered today. Bank stocks were up just like everything else, but I think this is generally good for banks. Banks have been running a positive vibe for the last couple of months. Their tailwinds have really been twofold. One is that if you remember when Silicon Valley Bank failed, they failed because they had locked in high rate deposits that they had to pay out, but had been buying fairly low rate or lending on fairly low rate loans and securities. So they had negative arbitrage in there, and they had huge mark-to-market losses, and that sent depositors and investors racing for the exits. This downward drift of the 10-year Treasury from 5% to 3.7% has eroded that negative equity, that negative arbitrage considerably. It has raised the mark-to-market values of their holdings. It has allowed them to exhale. That's one nice tailwind. Tailwind number two is for the last 24 months, the yield curve has been inverted. The 2-year has been above the 10-year, meaning they had to pay a lot more in deposits relative to their long-term lending book than they were used to. Normally, you have an upward sloping yield curve. Your short-term deposits are well below the rate on your 5 and 10-year loans that you're putting out, and you're arbitraging that positive spread. For 18 months, it's been negative, which has also put pressure on bank earnings, on their return on investment, on their interest income. So those two things are very, very positive for banks. And then I'll throw in a third, which is to the extent that lower rates help distressed borrowers work out some troubled loans, refinance out of some difficult positions, that's a third win for banks. So they have to be extraordinarily happy today with that 50 basis point cut.
One thing that we talked about on a previous pod was the Mortgage Bankers Association's forecasting a 26% jump in lending this calendar year, another 23% next year. So I went back to look at the volume, and if their forecast plays out, the 2025 forecast brings us to $717 billion, which is more than where we were in 2019. We talked about it being more realistic to kind of hope for a return to 2019 levels because 2021 just is not realistic at this point. But those are some pretty bullish forecasts from the Mortgage Bankers Association, where if their forecast plays out, it brings us somewhere in between where we were in 2019, which was a very rational market, certainly more than it was in 2021. So pretty optimistic. What's driving that forecast is not just the moderation in rates, which just began, but the need for loan maturities, which is going to get us off the low levels of the last 2 years. And I'm also hearing a lot of bullishness from private equity lenders who are happy to come in and fill any vacuum that exists from bank lending.
That was a great segue because I said, I was thinking to myself, you can't talk about the lending market in 2024 without talking about private equity, people that have been putting out money hand over fist since about 2019 via the CRE CLO market and through funds that they operate, funds like Ares and others that have been very active in this market. They might be even happier than the banks. Mm-hmm. They piled into loans in 2020, 21, 22 that were floating rate, backed by transitional properties, often on multifamily, that were 2, 3, 4 years in nature. And what they've seen over the last couple of years is this march higher in SOFR, which is the benchmark off which floating rate loans index, has marched from 25 basis points to 5%, to over 5%, meaning that borrowers were paying maybe 5% of their debt in 2022, we're now paying 10% in 2024. That squeezed out all of their profits and led to a huge uptick in distress in those segments. As SOFR comes down, this is immediate relief for those borrowers. They will start to see their free cash flow return. That should lead to a leveling off and eventually a decline in distress among loans in the CRE CLO market. And that will be a big win for both the borrowers there and the lenders in that segment.
So let's move on to the impact to brokers.
Well, I think you go through the hat trick or the triumvirate, if you will, of happiness, right? We talked about banks, private equity, the brokers, at least the lending brokers should be very happy as well. This should lead to another uptick in property sales, in lending originations, and in just overall economic activity. So whether you're a loan originator, you broker loans, or whether you're a sales broker, you're looking at the beginning of mourning in the CRE market, if you will, that the market should start to pick up almost immediately. That will be good for velocity, good for people's incomes, and that's a great thing. I think if you're talking about the broader broker market, probably does nothing for the office leasing market. That will remain distressed for a long time. But anybody who traffics in making new loans or helping buyers buy or sellers sell will be more active in Q4 than they've been for the last 30 months.
Yeah, I think so. And think about how long they've been waiting for this. I was in presentations a year ago where they were predicting interest rate cuts, and now they're finally here. So I agree, they're probably pretty happy right now and planning for a pretty busy end of the year.
And let me say, I am happy for them. This has been a really tough stretch. They have been kicked in the shins for 30 months, right? It's been hard to make a living. It's been slow. It's been a grind. There have been layoffs. Economic activity at times has been really anemic in the CRE market. So I hope they have their day. This would be a terrific outcome, and let's keep our fingers crossed that it takes place.
Investors and developers obviously will see an impact, if not immediately in the short term, they will as the rates continue to drop. What do you think is happening there?
Well, for developers, I think that the cost of funding has been so high recently, and people have been so skittish about deploying capital in terms of lending that it's been a tough slog for developers to get cash to start projects. I think that starts to get better. I think the purse strings have been loosening up for 6 months. I think they get looser now. The cost of borrowing gets lower, and more deals probably get greenlit going forward than have been greenlit over the last 12 months. So I think you see more activity, and goodness, we need more activity. We're short on single family housing. We're short on multifamily housing. We need more development. So that's a good thing.
And just last week, Manus, I don't know if you saw it, permits for home building went up. Confidence on the part of home builders went up. You have to think that the move by the Fed this week might help a little bit in terms of high labor costs, high construction costs, which was a big thing holding back that market in the past, 2 years. And I think on the investor side, there's a lot of excitement if you're an opportunistic investor, especially if you have your own dry powder. I think, we've all been through cycles like this before, and the best deals are struck when no one else has liquidity. So I feel like the market's loosening up on all sides. And the big question is just how fast things are going to move into play.
So Manus and Dianne, you've seen a few of these cycles. We've seen distress across a couple of asset types, and that was quantified in terms of delinquencies or special servicing or other things, turning over the property and the loan back to the lender. Any predictions of how that's going to play out over the course of the next few months and how long it takes for something like that to play out?
I think the market's been impatient for distress to materialize. Obviously, I'm talking about folks that have capital that they want to invest in distressed assets. In certain sectors, it's going to take years to unravel, office being the obvious. But we're going to see, the wheels start to thaw out a little bit. I think there are certainly willing buyers as distressed assets come on the plate. But as any market cycle has taught us in the past, there will be opportunities and there will be losses across the board. And the different rates of distress are going to be as different as the health of each asset class and even sub-asset class now.
Other than office, where I think that the number continues to point north, the compass continues to point north for several more years, I think everywhere else we start to see a leveling off of distress. And I think that leveling off is not an enormous change. I think it represents this, that if you have 100 borrowers that yesterday were in distress because of high rates, and that distress was because their floating rate was high and or they couldn't refinance. Now today, maybe you have 90 of those types. There's 10% that will benefit from the lower rate that came in yesterday. There'll be just enough cash freed up for them to hold on, or there'll be just enough proceeds for them to refinance out. So I do think it stops what had been a really sizable month-over-month increase over the last year or two. So I do think we see a leveling off, and I think that's a good thing. I do think that that's what the market needs. There's been a lot of negative headlines. It's time to start seeing some positive headlines.
So even if it's not getting better, it's at least not getting worse, Manus. Is that what I'm hearing?
Well, I think that's kind of it. I also think that if you've come this far, if you've gone 24 months of watching your cash flow erode, of sitting through 9 or 12 months of 10% borrowing costs as SOFR has been 5%, if you've come this far, why would you give up now, right? So I felt this way in the retail segment 5 years ago, that for those mall owners that didn't throw in the towel after JCPenney filed for bankruptcy, Sears, Toys R Us, Sports Authority, if you went through all that and you went through COVID, why would you give up now, right? Things are finally starting to turn around. And I feel the same sentiment now in distress, that you've gone through the fire, right? It's now morning in CRE, right? It's time to reap the benefits of lower rates and things starting to come back to normal.
And we'll leave it on that note. Thanks to our producer, Josh Bruning. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening to this special podcast and have a great week.
Let's go.